Hi, welcome to the Universe Guru. And today we'll talk about investing strategy right now, and particularly I'm talking about the Q4 of 2016. And the reason for this video is a lot of people have been asking, especially a lot of my friends, they've been saying, okay, Dow is hovering between 18,000 and 18,500, kind of going back and forth, and it's kind of high, right, relative to where it had been not too long ago. So what they are thinking is it a good time to invest in the market, or should we just wait and wait till like a crash or something, a major correction in the market, and then invest? Because it's right now, if you invest and then there's a crash, then you're losing money. So that is a very common question. Obviously, nobody knows the answer, right? Because if you know what's going to happen to the market, you'll be really rich. So without knowing that, what is the best strategy? So I cannot tell you specifics on what to invest and where to invest and when to invest, but I can only give you a general guideline on investing strategy in general. So in general, I think we've talked about that before. My general approach is never try to time the market. So timing the market means that I'm going to try to predict or speculate when market is high or when it's low. So and then I'm going to try to time the market and therefore try to make money that way. So when you don't time the market, what do? Well, it's very simple. You just keep investing whatever part of your savings, as you should, and then it kind of averages over time, right? So if you're investing the same amount of money all the time, then it doesn't matter in the long run what were you able to time it properly or not, because in general, on average, yeah, there's going to be fluctuation up and down, but the general trend has been, if you look at the market over the very long periods of time, the generally it's going up, right? 7-8%, whatever, depends on the index you look at. And so if you stay there and you look long term and you don't worry about the day-to-day fluctuations, then you will be riding that long-term path and you'll be all set. So that is why my philosophy is don't try to time the market. So then that question I started with kind of goes away, right? The answer would be, yeah, always keep investing. The other thing is in the emergency fund that we talk about, right? It's important, right? So regardless of where you are, right? If you are in on the path to, you're already debt free and you are on a path to financial independence, like some of us are, then emergency fund is kind of a no-brainer because you're probably already there. Many people are not quite there, right? So emergency fund, 6 months to 8 months to 12 months of money, so that, and that's liquid money, that's not invested money. So you should have that, not touched, and that's only for emergency, as the word says, right? So what does that have to do with investing strategy? Well, it does, because if you don't have that and you invest money and you counting that investments as part of your emergency fund because you don't have one, then let's say the market crashes and you need that money, then guess what's going to happen? You're going to have to sell those in the worst possible time, which is when the market is low. If you have the emergency fund, then you can ride it out, right, which is important. You can ride it out, or in fact, in many cases, if the market is really low, you may want to actually pump in more money. That's what Warren Buffett says. He says, I'm happier on a bad day for the market, because that's when he pumps in more money. And then every crash you look at, right, 2008, 2000, the market always comes back, and comes back not just to where it was, but goes beyond that. So if you just stay there, you will not only come back, and you will come back stronger, and so not only that, if you pump in more, then you will be actually happy that the crash happened, versus if that crash never happened, because whatever you invested while it was down, that money is going to be up a whole lot, plus the whole market is back up again. So that's the important thing about writing it out. I think the best phrase that I heard ever was about this was from Dave Ramsey, and he likes to say that roller coasters don't kill you; you only get killed when you jump out of them. So that's what happens when people panic. They say, "Oh my God, the world is falling apart, and market is going down." Yeah, there's been days or weeks where market crashes like you won't believe, and market crashes are scarier because the market never goes up that fast, but when it falls, it falls much faster. So if you stay there, you'll be fine. And that's why the link to the emergency fund, because you can write it out only if you can survive without touching into those investments, right? That's one thing. The other thing is always diversify, right? Your investment should be whichever way you want to do it. It depends on your risk tolerance, right? In general, the higher risk investments will be more rewarding in many cases, but it could lose money also. And the lesser risk involved, the return is also going to be less, right? That's a no-brainer. Like for example, if you put money right now in savings account, the return will be almost nothing, but so is the risk, and so on and so forth. So if you go to the more riskier ones, like for example individual stocks, which I don't recommend a whole lot because they're riskier. Something happens to that company, you can lose a lot of money. That's why I talk more about mutual funds, index funds, ETFs, and stuff like that. I've done a whole video explaining the difference between them, so you can check it out. We'll put that in the description down. But depends on your risk tolerance. If you don't have a risk tolerance, if your expectation is that, if I put in money, I expect a steady stream, the market never goes down, I get a very, simple, linear return, then, the stock market is not for you, right? To be in the stock market, even if you're putting in diversified index funds or mutual funds, ETFs kind of, strategy, it's not going to be as smooth. It does smooth it out compared to individual stocks, but it doesn't smooth it out because if the market goes down, the whole thing goes down. So unless you have the stomach for it, that's not a thing for you. But if you have the stomach for it, make sure how much stomach you have, because it depends on your risk tolerance. Now, one thing I will recommend is that the people who have a tendency to, invest in individual, high risk stocks, if you have that tendency, the one way you can balance the two, that you kind of satisfying your urge to I know this stock is going to go well, my friend told me, or this I've done some research on it, and when this happens, that stock is going to really kick off. And then you kind of, when really it happens, and then you kind of get upset with yourself, oh my god, I should have done it, and then you get negative about the whole stock market, that oh my god, I missed out on an opportunity. If you have those urges, one approach to incorporating that in your investing strategy is to allocate a percent. So then that's actually what I do. What I do is I allocate a very small percent, like almost like 5% or so, just to kind of fiddle with that urges, right? So this stock is good. I think I know, like the fundamentals, or certain stocks have a very high dividend rate just because the value is so low right now, and they're still giving a very high dividend rate, like 8, 9, 10%. Whatever your reason for liking that stock is, have a small percentage in there. That way, even if that stock goes down, or something really bad happens, or even it goes bankrupt, it's not going to make a huge dent in your portfolio, but you kind of satisfy that urge, which otherwise, if you don't fulfill it, you might tend to gamble in a bigger way, and they'll hurt you even more. So that is my general strategy on having a small portion for low cap, higher risk, higher beta, we call that beta, more volatile stocks. I mean, basically what it means is higher risk, higher reward. So, but it could be, there's a flip side to that, because you could lose big too. So have a strong, small allocation, not big, and again, depends on your risk tolerance. But again, you have to be disciplined, right? That's the key, because there's if you see that either way, right? Sometimes what happens is you win big, and he says, oh my God, I only had 5% of my portfolio in this. What if my entire portfolio was in that stock, right? And then the greed starts sticking in, right? Every time there's an opportunity, you'll be like, oh, what if I only invested more? And then if you lose, then you have a tendency also, because you say, oh my God, I've lost money, I got to make it up, and I have to place bigger bets, just like gambling, right? Gambling, both parties want to keep gambling. Even if you're willing, you say, I'm not going to stop, I'm winning. And if you're losing, you got to make it up. So it can easily escalate into bad behavior. So you have to be really disciplined, and if you're not, then try to stay away from it, and stick with the the mutual fund, fixed allocation kind of approach, where you say, okay, I'm certain amount of money every paycheck is going into some kind of index fund, like SPY or some Vanguard funds, BFIAX, or anything that kind of represents a big market. Doesn't matter if you look at all of them. If you plot the trend, they almost fall on top of each other. So it's about the same. So stay with that as much as possible. Also, the other thing is, have some of your own investing rule book, right? And that way you kind of stay honest that, okay, like I said, this percent is going to be, high risk one, but I'm going to keep to within this percent. Or even if you have some rules. So there's some exceptions to, timing the market, right? So I said, generally you don't do that, but I have some exceptions. And what those exceptions are, is, so whenever you try to time the market, you're trying to do it based on some news, right, or speculations. And the thing about that is that by the time, you heard about it, everybody else has heard about it, it's already too late, right, because everybody knows the same thing. And if it's not, it's probably some insider trading, which is illegal anyway, right? So how would you, try to time the market with some information? The only exception that I see is overreaction, right? Because, people have the same information, but people tend to overreact, and the way the computers these days do the rating, some kind of news can go too far, right? So one perfect example is the Brexit that happened, right? The news came out and the stock market kind of took a tumbling, like 800-900 points. The dollar lost in like a couple of days, and I knew it was overreaction. The market did not deserve to fall that much. The U.S. Stock market does not depend that much on that decision, and it's not going to kick in for that, for a long time anyway. And so I knew that was an overreaction. So guess what I did? Instead of being worried that, oh my God, stock is falling, I actually pumped in some money. So that was my exception to the timing the market rule, is that when you have some feeling, some common sense piece of evidence that the market overreacted on something. A lot of times some news comes about individual stocks. If you own some stocks, it may overreact a little bit, and then you can take some advantage. It's not a sure bet, again, it's a little bit of a risk, but it could be a calculated risk. So that is my only exception. When I see people overreacting, I actually pump in money, and by and large, even if it doesn't pay off now, there's no way to say that the day I put in money for the Brexit, what if the market had fallen down further, right? But if I put in and say, okay, this is part of my routine investments anyway, I'm just putting a little bit more just because I saw an opportunity, right? Then in the long haul, I'll be fine. But if I try to day trade and say, okay, I'm going to buy it, and when the market corrects, I'm going to sell, then you get in trouble, because then you're trying to really time the market, and there's no proper way of doing it. The other thing I would generally recommend is also having stocks that have dividends, healthy dividends. And in general, I like the dividends because that fulfills my idea of what a stock should be. Because if I'm investing in that as an owner, then I expect that if they make money, then as a investor in that stock, I get some share back. And that should have been the prime way of making money these days, because of the way the trading happens and with electronically and all that. The capital gain, which should have been the secondary way of making money, where the stock value goes up and you make money, that has become the primary way, and that's the reason why a lot of the volatility is there. If you think about it, if you invest in a business, somebody is investing in a gas station and say, you want to put in some money, I would expect that I would get a regular stream of money from that business. I wouldn't expect the answer that no, all money we get, we'll keep investing there so that the value of this investment keeps going up. No, I would expect some money back, because that's how investments work. And so in general, I like dividend stocks. Also, if you think of in terms of when you retire, right? So if you're saving for retirement, having money in dividend stock makes life easier, because one of the ways to retire is, we call the withdrawal rate, right? So one of the famous ones is 4% withdrawal rate. So if you have X amount of money, which is 25 times your annual spending, then basically the idea is you can keep withdrawing 4%, and that money will last forever, because the average return, even including the inflation, will more than cover that 4%. So you're taking out, but the money is growing with that rate that it never it's like a perpetual revenue. So, but the problem will be that if you don't have dividends in there, you will have to decide to sell certain of your portfolio just to withdraw that 4%, and then you'll be like, okay, when do I sell? And so what makes life easier is if a major chunk of that is dividends, then you're just getting the dividends. You don't have to sell anything, and then not having to deal with the urge to time the market when to sell, right? There are some strategies out there in terms of withdrawal rate that say that, in a bullish market withdraw this much, in a bearish market withdraw this much, and then it just kind of gets messy. So to keep things simple, you could just have a simple strategy that, you have a lot of dividend stocks, and therefore you get, part of your returns is in the form of dividends, and then it's just the way dividends work is every quarter they give you something. You don't have to worry about when I sell how much. You're just getting dividend just like interest. So so that I fundamentally like dividends. Also, one of the things I tell people is don't check the market even too often, because that kind of makes you more anxious. There's some people who check the market like 4, 5, 6, 10 times a day, and then every fluctuation that's happening that may have nothing to do with anything, but they will try to overreact and say, oh, you know what, oh my God, my portfolio is down, oh, my portfolio is up, and you may have the urge to do something about it. If you leave it alone, you'll be fine, right? So you watch it just from a distance, just so that you can tap into what's generally going on. Like I mentioned, there's an opportunity like the Brexit one I was talking about, but you don't have to check it many times a day to capitalize on that, right? So once in a while is fine. So that was a general idea. So coming back to the question, should we invest now? The answer is yes. And so I was talking about, this is mid-October 2016. So just for when you're watching this video, just to ground you where we are. But the answer to that question is the same no matter what. Even if we were deep at the bottom of a bearish market, the market's really down, the answer would be the same. So again, don't try to time the market if you were just consistent. I think the key is consistency. You save money, with all the techniques that we talk about. You have a good savings rate, and then the portion of that goes into investing with the appropriate mix of risk, right? That works for you. And as long as you're consistent, you will accumulate wealth, regardless of what the market does. In general, the market will go up, and you will take advantage of that. So that's all I had for investing strategy. I know some of you will be disappointed because I gave you a general answer. A lot of you will be saying, okay, what securities to buy when and when not and all that. But I'm not going to give you a false answer. This is exactly what I do. So I'm not going to tell you something that I don't do. I stick to my plans. Like I said, I have some rules, and I try to follow them. That way, if something happens, even if there is an opportunity cost, there was an opportunity I didn't. I'll be more comfortable saying that no, I stick with the rules, and in most cases I will benefit from that. Every time I deviate from the plan, and I miss an opportunity, then I'm really, really pissed because why didn't I stick to the plan? All I had to do was just follow my own rules. So that's another reason why you want to just have a simple strategy, not very complicated. Have more of an allocation base that I'm going to have this much money in here and this much in this kind of investment vehicle, and every now and then reallocate that, and just the volatility will work in your favor, because when you reallocate, let's say you have certain amount in stocks and certain amount in bonds, or for example, just to look at the two. Let's say the stock market went up and you reallocate. Guess what? You will be selling when the stock market is high, by definition, just to reallocate, right? And vice versa. If the market falls down, then when you reallocate, you'll move from bonds to stocks. Guess what? You'll be buying when the market is low. So just by some simple reallocations that you can do maybe on a quarterly basis, keeps life very simple. It keeps your approach independent of what the market is doing, because again, you have no control over it, right? So I have a strategy that relies on you predicting what's going to happen. So always have a strategy that is independent of that, and have a strategy that works regardless of what happens. And in fact, in many cases, more volatility will actually help you, because when you reallocate, you'll benefit from the fluctuations. So that's all. Let us know if you have any comments, any variations in this that you have played around with, or any experiences that you have. What are you doing right now with investments in general? And again, as usual, if you're not a subscriber, feel free to subscribe so you stay tuned. And also, we would appreciate if you share this and like this. Thank you very much.